What's going on, Wealth Builders? My name is Kyle Demian, and welcome to another episode of the Wealth Building for Dummies podcast. I'm joined here, as always, with Renji Matthew, and on today's podcast episode, we're talking about the troubles in the stock market and how some of these big tech companies have actually had a terrible week, some of their worst weeks over the past 2+ years, and more specifically, just the S&P 500 as a total was down 2% in just one day on Wednesday, July 24th. And that was the first time that has happened since December of 2022. So we're going to talk about, potential market predictions and projections with some of the experts and what they're saying, what the market's going to look like maybe over the next 12 to 18 months. We're going to talk about some different ways for you to protect your money. And as always, full disclaimer here, this is not financial advice, simply just financial education. Make sure you're meeting with a licensed financial professional before you make any decisions of what to do with your money. But this is simply just intended to be educational, to show you some different opportunities that may be out there for you. And as always, this show is not intended to be financial, legal, or tax advice. So thank you guys for hanging out with us. And with that, Renji, let's talk about it. So on July 24th, on Wednesday, the S&P 500 slid and dropped down over 2%. Which is the largest decline that the market has seen since December of 2022, almost 2 years, about a year and a half ago. So kind of walk us through, obviously if you're in the stock market, you're aware that there's some risk that comes with it, right? But as you're getting closer to retirement, and that's typically what we focus on, is retirement or getting into cash flow or passive cash flowing assets to be able to protect your money, control your money better. But should people be worried about this 2% market crash? And what are your thoughts? What are your opinions on it?
Well, no matter what you're doing, if it's into owning your own business or having something passive income wise, or even retirement accounts, you're going to have risk no matter what, right? You take the risk of, hey, what's the market going to do? You take the risk of, hey, how's my business going to do? Right? You don't know what the future holds until you take that step. Right. And I think at the end of the day, we don't even know if this is it, right? We don't know if it's going to get worse, especially it being election year. Who knows what's going to happen at the end of the year, So the funny thing is, this is something people have been predicting for a while, but the market went against a lot of the predictions, right? A lot of the predictions were we would be low this year, but S&P did good in the beginning of the year. So I don't think people really know. I think it's always the best guesstimate they can make, right? But then when, annual or quarterly reports come out, that's when we see. So if you're someone that actually studies the companies you're investing with, the stock companies that what they're doing, and if you're watching like the filings that they have quarterly, then you might have a better chance of say, okay, this is, I think, what's going to happen. But if you're like most people that don't watch any of those things and are just putting your money somewhere blindly, you are definitely taking the risk of, the market going down. On the other hand, you're also the market could do really well and you did good there too. So I think the biggest thing is it depends on what your goals are and how close you are to retirement. Because if you're really close to retirement, let's say you're about to turn 60 and you're thinking about retiring by 65, how much of your money are you willing to take a risk with, right? So when you're younger, you don't care as much. You're putting money away. You have plenty of time before retirement. But as you get closer and closer to retirement, you have to start thinking about, hey, this is money I need to live on when I retire. So maybe I should start protecting some of it. Right. So putting maybe 50% of that into something that is protected so that if the market does well, you have growth in everything. But if the market does bad, at least 50% of your account is protected. So I think that's what people should be thinking about. And even on the business side of things, if you're getting into entrepreneurship or starting your own side hustle or whatever business you have, there is a lot of risk. But that's why being an entrepreneur is not for people that can't take risk or take failure, because you will have failure. That's part of life, But being a successful entrepreneur goes through those failures and takes those failures as lessons so they can get to the next level, right? So I think no matter what you do, there's going to be risk. It's just the question is, which path would you rather take, and
Exactly.
which difficulties are you willing to go through to get there, right? What are your thoughts, Kyle?
Well, yeah, and just like you were saying, risk isn't necessarily a bad thing, and taking risk in the market isn't necessarily bad, but too much risk, too close to retirement, could be detrimental. Ask anybody that retired in the year 2000 or 2008 and ask them how they feel about market risk, right? So that's the thing. It's going to be different for everybody. Everybody is going to have different thoughts and views on the market. We talked to a lot of people, I'm sure you've heard this before, Renji, that they think the market is like a casino. And you go in and you come out down more often than you come out up. Other people love the casino, right? And they love putting their money into the market because they study the stocks, like you mentioned. They study the reports and they know what they want to invest in and they know what they want to do. But every single person is different. And diversification is something that can't apply to everybody. You guys have probably heard the term before. You don't want to have all of your eggs in one basket. And that is one of the ways that you can protect yourself, right? And with that, like we talked about getting closer to retirement, and that's kind of where we wanted to go with this podcast is what you should do if you are getting closer to retirement, because as you get closer to retirement, you should start to diversify and protect more of your money. And now how much of your portfolio should you protect? What should that look like? Some advisors follow the rule that whatever your age is simply approximately how much that you should have protected from the market. So if you're 58 years old, maybe you should have about 58% of your portfolio shielded from market risk. Others follow the rule of 110. These are like the two traditional financial planning routes. The rule of 110 says you take the number 110, you subtract your age from it. So we'll use 61, for example. And then that number, which is 49, shows us what percent of your portfolio should be at market risk. So you'd have 49% at risk. That means 51% out of risk. Those are just two of the probably most common ways that we've heard before, but simply enough, meet with a financial professional, tell them your goals, tell them what you're at, tell them what your worries are, and they can help you determine what is the best for you. Now, Renji, let's start to talk about like what the next 6 to 12 to 18 months might look like, because you mentioned there is an election coming up. And now obviously I'm not that old, but this is probably the most tense I've ever seen an election versus, Democrats versus Republicans kind of just butting heads back and forth. And some people think of elections as being like a negative thing for the market. Now, historically looking back, elections really haven't had too great of an impact on the market. But what I start to see and what I look at is the fact that we're in a high inflationary period of time. The interest rates right now are high. The real estate market is priced high. We've got a huge election coming up. So there is a lot of things. The market's at all-time highs. They didn't even talk about that. But there's a lot of things that are kind of lining up where once you reach the peak of any business cycle, of any market cycle, what follows every single peak? It's a contractionary period that could potentially lead into a recession, right? We know these things because Renji and I are going through right now studying for one of our securities licenses. So this is top of mind, especially, but like this is exactly where we find ourselves at. And here's the thing, you never know when you're in the peak of a market while you're there. You can only tell where the peak is after the peak happens. And when you start to go through these contractionary periods or these down years, right? So with that, I talked a lot. Renji, I'm going to turn it over to you. What are some of your thoughts on what I said and expand on that for us?
Yeah, I think it really depends on your goals. If you're talking to an advisor and they don't even ask your goals and they just won't go into products, be wary of what they're going to talk about, because if they don't even know what your goals are and they start putting you into different products, it might not be at your best interest, right? So we need to know what your goals are, because everyone's goal is not the same, right? There's a majority of people that might have similar goals, but everyone's goals could be different, right? So what your goals might not be my goals. So whoever you're talking to, they have to know what your goals are, where you're trying to get to. That way they can lay down a plan for you to get there, right? The best plan they can lay down to get there. So another thing you mentioned about like the elections and going up and down, one of the things that we talk about pretty often on our podcast is how much control are you giving the government and how much control are you keeping yourself, right? With the stock market or with 401ks, nothing's wrong with any of those. If you're interested into putting money into those and you're making money, it's doing good for you, good. Keep continuing to do that, right? What we like to talk about is when you own your own business, you're keeping more control. Like setting up a trust, you're controlling a lot of your assets even when you're gone. When you put all your money into the stock market or tax deferred accounts, something that you need to think about or at least keep in the back of your mind is these are like the 401ks, IRAs are all tax deferred. So if you're trying to keep deferring taxes to the future, you might be in a world of hurt because taxes could be a lot higher in the future, right? So these are all things to take into consideration. And this is why we say with traditional retirement accounts, you kind of are giving the government more control because they can raise the tax rates anytime. Income tax brackets are changing all the time. Not a lot, but they can change that every year if they wanted to. So with our national debt being as high as it is right now, the only way to pay that down is by increasing taxes. So if you're still in the mindset of, okay, let me put all my money into tax deferred accounts, when you retire, let's say that's in the next 10, 20 years, taxes might be a lot higher than it is now. So those are some things to take into consideration. So what I say all that to say, you're giving the government more control in that sense because they can tax you however they want to. Right? When you own your own business, there's a lot of tax loopholes and different ways to, and it's not really loopholes, they're tax codes written for business owners to be able to, use them so they can keep more of their money. So those are some things to take into consideration. But no matter what it is, whoever you sit down with, you just have to make sure they know what your goals are. They're at least trying to hear you out to see where you're trying to get to. If they're not, think about who you're talking to, right? So that's just what I was thinking.
Awesome. And with that, I say let's start to wrap it up. And one thing I wanted to talk about that we didn't get to just yet was like most people aren't even aware that there are retirement accounts out there where they're called indexed retirement accounts, or indexing is the strategy where you get the growth and the gains of the market without any of the losses. So you could have your money into like an S&P 500 index. While the index is going up, you take part in those gains. When the index is going down, you lock in what's called a floor rate. And so you don't lose any of your money. And this could be a smart strategy if you are close to retirement and or if you're looking for a way to diversify and to protect your money just in case the market does go down. So, Renji, anything else you wanted to talk about with the index accounts? Otherwise, I'll have you wrap it up for us.
Yeah, so traditional index accounts, they're in the market also, so you can still go up and down in that. But there's index strategies inside, like Kyle said, accounts that have a floor. These could be tax-free and they could be tax-deferred. The tax-deferred accounts are IRAs also, but you're still going to get taxed, but at least you can control the losses, right? So it goes back to something we talk about pretty often also, break-even burden. So you might not be worried about the market ups and downs, but there's something called a break-even burden, which means, I'll just use simple math. Let's say you have $100,000. If the market goes down 50%, you're down to $50,000. Now, when the market comes back up 50%, a lot of people think they'll be right back to 100. But 50% of 50,000 is only 25,000. So they're only coming back up to 75. So you have to go back up 100% to get back to 100,000. So imagine if you had a zero floor where you don't lose money. When the market goes down 50%, you're still at 100. Now when the market goes up 50%, you're at 150, and that's just 1 year. So imagine how much more money you would have in your account when you retire. Let's say it's 10, 20 years from now. There's going to be so much more in those accounts. And these are different things that are out there. Guys, the thing is, you got to do your research because Yes, your job will offer you 401ks, IRAs, Roths, right? There's a lot more options out there that your jobs won't offer, right? So you have to go do the research. You have to sit down with an advisor that knows about these options and that can use different strategies to help you reach your goals, right? So if that's something you guys want to do, drop us a comment, reach out to us. So we can also sit with you. Again, none of this is financial advice. This is just educational. But do your research, find out what all is out there. There's a lot of different options. And even these accounts have good and bad ones, right? So that's why you have to sit down with an advisor that has a wide range to help you.
For sure. And with that, just for clarification too, we did talk about like an index fund or an index, which could be like the S&P 500. The strategy that we were talking about where you get those gains without the losses is called indexing. So they do sound like they are similar or very, very close. But if you just put your money in the S&P 500, there will still be market risk. You still can lose your money. We are talking about indexing strategies where you get the growth of that selected index without the market risk. So I just wanted to say that and wrap us up with that just in case, because I think I might have said it a little bit funny earlier. But with that, if you guys like these conversations and like learning about money, we created a whole school community with about 30 plus other motivated entrepreneurs and people that like talking about money as well and engaging. We have that community. We'll have it linked below on our YouTube here. And as always, if there's anything that we could do to help out, feel free to reach out to us on social media. We'll have our handles linked here as well for you guys. And be sure to like this podcast if you got anything good out of it and share it with a friend. You know, we don't charge you guys for these podcasts and for these shows. We're simply here to educate and inform and to help others build wealth. So if there's anything that we could do for you guys, let us know and be sure to subscribe to the channel. We'll see you guys on the next podcast. Take care.